Susie, when we talk about different types of sale, trade sale is a term that's often used. Can you just help the audience understand what that means?
Yeah, so a trade sale is an acquisition by someone typically in your industry. So somebody who's maybe a competitor who's buying you as complementary to their business to build their business. Sometimes a trade sale might actually be someone who just needs the business that you have as an add-on to their business. So they may not be similar, but it's somebody else acquiring you rather than a kind of a financial investor.
Understood. And what types of consideration would an entrepreneur expect to be offered by a trade buyer?
Yeah, so from a trade perspective, cash. I mean, everybody wants to get some cash when they sell their business, but really commonly in a trade sale, you'll have a form of earn-out, i.e. an amount that is not payable on the transaction, but is payable later, and is probably contingent on hitting particular targets or meeting certain milestones. And so earn-outs, if you're a tax person, are really interesting, and the tax treatment of an earn-out is quite interesting.
And how are they taxed?
Yeah, so it really depends if they're ascertainable, which is to say you're going to get X amount and you know how much you're going to get, just not necessarily if or when, or unascertainable, which is more common. So more commonly we would see consideration being you will receive X amount, say, of EBITDA or revenue. For us, tax people, that's an unascertainable earn-out. And the tax treatment of it is, without any planning, is that you're taxed on the market value of that right. So you kind of look at what that right is worth. You're taxed on that upfront. And then later, if you receive more, essentially, you're taxed on that. And that can be difficult for people because particularly in more early stage businesses, they will be very heavily weighted in favour of earn-outs. And if that earn-out is valuable, you may have a really high upfront tax charge, but no cash consideration to pay the tax, which is where we often help people by structuring and most commonly using loan notes to defer that tax charge until you receive the consideration.
And you mentioned tax there. I'm assuming capital gains tax?
Yeah, no, it's a great question. You would expect it to be capital gains tax, okay? You want always to be within the scope of capital gains tax. But earn-outs can be quite interesting because very often when you have an earn-out, the expectation of the purchaser is that you stay in the business to help prove the value of that earn-out. And generally as a seller, you'll want that too. You want to be in control of the performance of the business during that period which your consideration is contingent. For the revenue, of course, that introduces an interesting question, which is, so you've got to stay in employment to receive this amount. Does it look like employment income? So as tax advisors, a big piece of our advice is very often, is this earn-out actually income tax and chargeable therefore at up to 47, or is it capital gains tax? So that's a really important piece of our advice.
So I'm assuming the difference there is between am I selling my shares or am I being rewarded for future performance? Is that right?
That's exactly the question.
Okay.
And there's some really easy tests sometimes. So if you've got an institutional investor and you've got a management team and they both get the same consideration, i.e. they both get the earn-out, that's quite easy because the institutional investor's not working in the business. If the institutional investor's getting a different mix of consideration, it can be more tricky.
And in terms of trade sales, anything else we need to be aware of?
No, I think sometimes on a trade sale you see it structured differently whereby they'll buy, say for example, a purchaser might buy half the business, so 51% of the business up front, and then with an ability to buy the rest. That's almost like an earn-out sometimes, so you can structure the way that the second half is sold. Sometimes on an earn-out, you will see, in a more typically in a buy and build, you'll see also some share capital, so you might also get share capital in a purchaser.
And sometimes an entrepreneur will be approached by a buyer and they'll want to buy the asset or the business rather than the company shares. Is that a good thing?
So no, not a good thing generally. The beauty of selling shares as a UK resident individual is that you'll pay capital gains tax on the sale of those shares. If the business sells its assets, there's a corporation tax charge, and then you've got an extraction cost in trying to get the money out of the business. So from our perspective, our answer to that would always be no. But it is not uncommon, particularly with US purchasers who might not want a UK entity, so they might tell people that they'd like to buy the assets. What I would say is that it's really important for people to get advice on their heads of terms before they sign them, because often we see people thinking they've got a great deal, they've signed a heads of terms for the sale of the assets, but from a tax perspective it can end up being not a great deal.
Susie, thank you so much for today. Really insightful thoughts. And if anybody needs any help with understanding the tax implications on selling their business, please do either give myself or Susie a call. Thank you.